The signal of the day comes from finance. That is, we are going to look at an application of signal processing to financial data. More specifically, we are going to explore the time series of stock prices of Lehman Brothers around 2008. Lehman Brothers was a global financial services firm and one of the largest investment banks in the US. We have to use the past tense here because on September 15, 2008, after more than 150 years of existence, the firm filed for bankruptcy. How could it be that such a large and respected bank could suddenly go bust? The bankruptcy is just the final act in a series of events that ultimately led to it. Lehman Brothers was highly exposed to the US housing market, in particular to a type of loans known as subprime mortgages. These loans were typically granted to clients who were not able to afford standard loans due to their limited financial capabilities. With the burst of a real estate bubble in the US, these clients were the first ones to default on their mortgages. That is, they stopped paying back the banks. This led to huge financial losses for the banks that were exposed to this market. In 2008, these losses had another even larger impact on Lehman Brothers. Suddenly, investors and other banks started wondering whether Lehman Brothers had the financial means to face its own obligations. From there, the situation started spiraling. Losses induced investors withdrawing their money, which led to even more losses. On September 15, 2008, facing liquidity problems, Lehman Brothers had no other choice than to file for bankruptcy. Now that we understand the origins of this bankruptcy, let us have a look at the price of the Lehman Brothers stock around this major event. In this plot, we are showing the Lehman Brothers stock price between the years 2004 and 2014. This plot clearly shows a drastic drop in the stock price at the time of bankruptcy. This happens because in the event of a bankruptcy, stockholders have the lowest priority in claiming remaining assets of the company. Let us have another look at the signal through a different lens, namely, we make a display on a log scale. With this plot, it is better to see how the value evolves after the bankruptcy. The value does not go to zero. Why is that? Holding securities like this one is associated with a high level of risk, due to the possibility that the investor will never recover his investment after bankruptcy. Thus, the securities trade at a discounted value, typically a couple of cents. At just the same time, these securities present high return potential. Indeed, just imagine you bought the stock when it was worth only $0.001 and sell it back at 1/10. In that case, an investor would get a return of 1,000%. Certain investors specialize in this type of investments, referred to as distress investment. To cope with these situations, a tool able to detect abrupt changes in stock prices would be highly desirable. Consider, for example, the simple spike detector whose block diagram is depicted here. The first block is a moving average. This moving average we have already seen when we analyzed temperature. It simply computes the average of the signal over the last capital L observations. Its output is a smoothed or so-called low-pass version of the original signal. By subtracting the low-pass version from the original signal, done here, we are extracting the high-pass component. The latter goes through a thresholding operator that is triggered if the value is greater than a certain threshold. Let us apply our spike detector on the Lehman Brothers stock price. These plots show the low-pass and high-pass components for a short moving average window. The window size is L is equal to 5. With a short window, our spike detector is prompt to react, but we might as well be catching false events, in other terms, noise. By increasing the length of the moving average window, like here L is equal to 50, the algorithm becomes less sensitive to noise. This comes, however, at a certain price. The algorithm takes longer to react to an event. Our spike detector is very rudimentary, and we would not advise anyone to use it to manage his or her investments. Besides, The trade-off between reactiveness and sensitivity we have already mentioned. There is a major drawback in this approach. Our algorithm is only backward-looking, so the detection of an event will always take place after it has occurred, possibly a couple of hours or even days after it has happened. At this point, market participants have most likely already concluded that a major event must have happened. The other problem is that we might not have all the good tools at hand to process such a signal. It is natural to introduce some randomness in the modeling of stock prices, as the evolution of the stock does not exhibit clear patterns, but the underlying statistical characteristic might be more stable over time. With random signals, certain tools that we have developed are still valid, like filtering. But we also need to introduce new tools, which is a subject of another class on statistical signal processing. Coming back to Lehman Brothers, this signal is of particular importance, as it was the largest bankruptcy filing in history, surpassing those of other giants like WorldCom or Enron. The Lehman Brothers bankruptcy is also thought to have considerably intensified the 2008 financial crisis. It was really a crisis of trust between the different market participants. Banks were reluctant to lend money to each other, as another bank could possibly also go bankrupt. This created a considerable drop in the liquidities available to banks and other firms, and contaminated the rest of the economy. What started out as a burst of a real estate bubble in the US evolved into a worldwide global financial and economic crisis.